if we look at that, the risks to US recovery, do you think they're bigger domestic risks than there are global risks? If I say fiscal risks versus global risk, how do you look at the world? How do you look at the risk?
Well, I think the U.S. economy has sound fundamentals right now. So, I mean, it's difficult to come up with very many downside risks there. If anything, the fiscal policy would be upside risks in terms of growth and pushing unemployment even further down, which, could have its benefits, as I said before, but you can overdo that. I think that the global environment is much more sound now, actually, and so I've been nervous about that, but I just can't discount the reports anymore from business contacts that say that Europe is doing better. It's better across the board. It's growing from a low level, and there's quite a ways to run beyond that, but things are going better, and I think China can shore things up as well.
Now, there's one word which is pervasive from all of the Fed speakers, and it's gradual. And we're talking about the balance sheet reduction, that discussion. When I look at the balance sheet reduction, it's the three words that strike fear into every bond trader's view, which is balance sheet reduction. You're not in charge of the bonds that you bought, that you have got on your balance sheet right now. In terms of when they mature, there's a whole hodgepodge of them.
That's right.
What do we need to hear from the Fed in terms of it's about 450 billion rolling off next year. Do you need to begin to tell us, look, we're going to have a steady momentum program. It's going to be month by month. Do you think that's what we need to hear from the Federal Reserve when that discussion comes about?
Well, so the Fed needs to articulate our strategy for monetary policy. I mean, beyond just achieving our objectives. And at the moment, we have a very large balance sheet. We have been increasing the short-term interest rates. Now with increased confidence, I would say that, we can confidently point to an upward sloping futures funds rate path, the SEPs. You did mention that the markets have a slightly lower path, but I think that our path is more likely to be the one that we
Stick by your dots.
Follow. That's correct. And I think that to accurately capture the stance of monetary policy, you do have to take into account the stance of monetary policy. The stance of the balance sheet. So, we've indicated that once funds rate increases are well underway, an artful term, that will begin to renormalize. And so, we've said in the March minutes that most participants expect later this year to begin this adjustment to the balance sheet. We're having discussions about what the right size and pace of reductions, how it will be conveyed. I would say that I know that I am mindful that we don't want to disrupt market functioning, but we want to be careful and confident that we're going to display a downward sloping path. It might take 3, 4, 5 years to get to the point where we then begin growing the size more in line with the economy growing. But once we get it confidently moving down, it can kind of recede into the background, and any adjustments in monetary policy can be taken with regard to alterations in the funds rate path.
The other discussion is this. Look, there's a wonderful piece written by a gentleman called Noel Carr that there are bad times just around the corner. If we look at the reality of economics, there's always ups and downs, and it's cyclical. There will be another rough and tumble period of time in American economy. Is it that you still want to have QE as a solid arsenal piece, or do you think the market is too demanding of QE to be a fixed facet of the arsenal of the Fed?
Well, I think we need to be mindful of the fact that we've adopted a 2% inflation objective. The world seems to be one where real interest rates are much more likely to settle in at about 1%. Put those two things together, and you've got a eventual funds rate neutrality at 3%. At 3%, there's not a lot of scope to cut interest rates when you find yourself needing to provide more accommodation when you're hit with shocks. On average, we've been cutting the funds rate by about 500 basis points or more in order to make adjustments over a long period of time. So, we are much more likely to hit the zero lower bound if we are hit with shocks. How should we prepare for that? Well, one thing, we need to make sure that we can at least get the funds rate to its, neutral level in accordance with the fundamentals of the economy. When the economy is ready for it, we're at the neutral level. Then we can have some scope to cut, but it's also the case that if we hit the zero lower bound and more is needed and other parties aren't willing or able to provide the accommodation, we would need to use other tools, and QE is another tool that we have used with some effectiveness in order to improve borrowing conditions for businesses and households at the long end. So I would expect that if we hit the zero lower bound and we need to do more, we will in fact turn to those tools.